Hey, founders and venture capital investors. Have you ever wondered how the new era of venture capital is done? Well, in this week's episode of Making Billions, I bring on my dear friend Robert Cote of Cote Capital. This guy turned the traditional venture capital model on its head, and doing so has generated over $3 billion in cash flow from those innovative methods. Creating new business models while innovating on how businesses are done are all skills we need in our pursuit of making billions. Here we go. Hey, welcome to another episode of Making Billions. I'm your host, Ryan Miller, and today I have my dear friend, Robert Cote. Robert is the founder and CEO of Cote Capital. It's a unique venture capital firm that has gone on to generate over $3 billion in cash flow and 112% IRR for his investors. So what this means is Robert is going to teach us his secret sauce on how to negotiate terms with companies so that you too can make those eye-popping returns in venture capital and private equity. So Robert, welcome to the show, man.
It's great to be here. I'm a big fan of what you do, and I'm happy to be on here and kind of talk about IP investing and what I've been doing for many, many years and what I'm doing now.
Yeah, this is phenomenal. So you have such a unique and wonderful investment thesis, and I can't wait to get into it. But before we do, I can learn about that, and we can read that online, and many of our fans in 100 countries will do that. But before we get into that, there's a lot of people starting out, just like you did at one point, just like I did at one point. So I'm sure a lot of our fans around the world would say, how did it start for Robert?
Well, I would say about 25 years ago in the 90s, I became an IP lawyer, something that I aspired to from being a young man. And I quickly became an IP investor, and that started with technology most of us know as PCR today, won the Nobel Prize in chemistry. We know it as the test we needed to take to travel for a couple of years. That technology allows you to amplify DNA in the body, actually see it, and be able to detect diseases, viruses, and develop treatments to save lives. So that's where I got my start. I spent 10 years kind of in the beginnings of becoming an IP investor. What I do today very much comes from that beginning. 10 years licensing this technology around the world. Basically, we generated a couple of $2 billion in revenue share. My model is a revenue share, not an equity model, as we'll learn about in a little bit. And so that began the beginnings of looking at companies as IP properties and looking at the engine in the car, not just the team driving the car, is what makes the difference between a good investment and a bad investment. And so I moved from that into a number of other technologies that founded industries in America, built industries. Probably the most notable that people are familiar with is wireless. The air interface, the technology that allows you to take your books, your movies, your emails, FaceTime, all of that takes the physical, turns it into digital, into energy, sends it at the speed of light across the world, literally, and into your pocket. And so that technology actually I helped scale around the world for a company, actually a Canadian company that developed it. And that technology is kind of a miracle in action. That was another example of a company that wanted to build corporate stores. They wanted to build their own equipment, wanted to do their own thing, but they quickly became licensees or licensors and realized they couldn't do as much as they wanted to do in the world. They realized they couldn't have the impact they wanted to have in the world. Same for the PCR folks. And they realized that if they franchised and licensed what they were doing and looked at that engine in the car as something that could create value around the world, they could build a bigger business faster, relying on more teams to create value for the business, for the technology, and they would share in the revenues from that. And so again, that's another kind of an example of venture capital investing where you're focused on the IP and you're focused more than on the team, than on the corporate stores that will build. You're thinking about how do I scale it to have an impact and build a business better, faster, and at lower risk. So that's kind of how I got started. in this business. Any questions?
Yeah, no, I'm sure I've got a lot of questions. So this is phenomenal experience. So PCR tests, like pretty sure most of planet Earth had a little bit of an experience with that, whether they wanted to or not. So, the inventors of that, and then Wi-Fi and 4G, 5G. I mean, all these things you've been tied into. These are monster technologies, and we'll get into some of the lessons you've learned.
And actually, just to throw in some returns, what I found from doing what I did was that you could get outsized returns if you had the skill set to actually understand what it was that you were getting involved in. We often gloss over the technology. It sounds good on the surface, but looking under the hood, like I like to say, the engine in the car, and really understanding how it works, understanding how it has value. And we saw it in PCR, a couple of $1 billion. In the wireless and other opportunities in the most recent 10 years was another $1 billion. And the way we structured those was 112% IRR. And so I became a big believer that instead of being a venture capitalist, I should graduate to being an IP capitalist. I could do it better all day long. And so I'd love to share some of how that all works with your audience.
Yeah, I love that. And I can't wait till we do. And you're going to want to tune into the end where I'm going to ask pretty please, and we'll see how much Robert opens up on his secret sauce. But definitely want to listen to the end where we can kind of crack that open. But now, so you started as an IP lawyer, you've done all these wonderful things, you've made some investments and some blockbuster investments, 112% IRR, $3 billion in cash flows generated. I mean, you are on fire. So now, speaking of that, maybe you can walk us through a little bit about Cote Capital and IP investing, and just give us the overview of what you're up to today.
When you're a venture capitalist today, you're largely focused on software companies. You play a little bit in the life science, biotech, healthcare arena, but mostly it's software. And that focus has come to plague venture capitalists because the innovations tend to be incremental. The ability to replicate what's happening tends to be incremental, and it doesn't have the impact that breakthrough innovations over in the physical side of the house, hardware, I like to call it, companies building new things based on breakthrough innovations that change how we make products, change how we use products, and create much more benefit than we have today. So instead of having, the next iPhone version, we're going to create the iPhone for the first time, right? And that became a very, very powerful innovation above the cell phone. Many of us scratched our heads and wondered how in the world, or what in the world would I do to pay $300 for a computer in my phone versus $100? But of course, we now know 10 years, 15 years later, it's a wonderful miracle that we have in our hands with many, many productivity tools in the form of apps. So software and venture capital has value, but the problem they faced is the incremental innovations that are behind it make it easy for a lot of Me Too. So they've struggled to exit their companies. The returns aren't there. And I learned for many years that the American empire, venture capital itself, all is built on building real products, physical products, breakthrough innovations, the semi industry, the computer industry, the automobile industry, right? And the airplane industry. And so I'm giving big names and big ideas, but there are many, many smaller ones that are equally impactful in the world. And so that physical side of the house, that hardware company, is where I want to take the world, the country, back over here, because venture capital has left them behind. As we shipped our manufacturing offshore and we moved to software, the capital started to fall away from these companies. So I lived it for 20, 25 years with the folks that developed PCR. I lived it with the folks who developed the wireless in your phone, Wi-Fi in your house. All of it was the same innovation. And so I heard I listened to their problems. I felt their pain. And I developed a model that basically would put capital to work. It takes a lot more capital in a way that made sense for them. One of the things they would complain about to me was equity was just very, very dilutive. When you have to take in $50, $100 million to build manufacturing out to actually be able to get that customer to sign that contract. They struggle with that catch-22. So my model intends to take you to break even. You don't live, round to round, I like to say, hand to mouth, paycheck to paycheck. You have enough capital to get to break even where you can choose whether you want to exit, whether you want to continue as a business. You choose your future. I don't demand it. And I'm going to share in revenues instead of in equity. So you're going to own your business as well. So that's become a really, really exciting thing to entrepreneurs that I invest with. The second thing was, if I'm going to really have an impact and really drive a mission that moves us from software back over to hardware, you need to bring capital in. I don't have all the capital in the world to do the things I'd like to do. So I need partners, right? I need investors. And so whether it's humanitarian funds who have an appetite for what I'm doing, or it's accredited investors that aren't wrapped in a box. Venture capital pretty much is locked into what they do, private equity. And so when they've left hardware companies behind, they're starving for capital. So I've aligned myself with the people who can get the greatest benefit, and that's the people in this country and in the world, to come in as accredited investors. And so I had to change the risk profile. So when you think about what we do today, instead of holding a lottery ticket, which is much of what venture capital is all about, that often doesn't pay out, by sharing in revenues in a company that's got something nobody else has, real IP, real technology that's breakthrough, where customers are willing to buy it to demonstrate they see that value, you have durability in revenues, and you have something even more important. It's very hard to replicate that innovation. It takes 5, 10 years. So I've got high barriers to entry. I'm not worried about being replaced, my company being replaced. So here I am with a model that allows these entrepreneurs to own their business and exit when they want to. What a game changer. And then here I am aligning with the people I think are most aligned with what I want to do that can get the most impact. And I knew that I had to change the risk profile. So I moved to a model that shares in revenues, so investors are actually paid to wait. They get their principal back along the way, whether the exit happens or not, right? And in my case, because it's breakthrough, the exit will happen. And I'm counting on that, and I wouldn't make the investment if it weren't so. So it's really more about making sure we can scale this company to get them to an exit if they choose. But we hold that revenue share in perpetuity. It's a high yield investment we can drill down on. And so again, I've changed the game for the entrepreneur. He owns his business, exit when he wants. And I've changed the game for accredited investors. They can come in and actually get paid to wait, and they still hold a piece of the outcome to buy out that royalty stream if, in fact, the company exits. If they don't, I've brought a new dimension that allows me and my investors to sell that stream off and exit on our own. And so I've really kind of changed the game in a lot of ways that really disrupt venture capital, and hopefully will inspire them to move over to my side of the aisle once again, because that's where they originate. That's where they came from. So hopefully not too much, but I want to really kind of get the inspiration behind what I do out on the table.
All right. Yeah. So you're seasoning the steak to make it sizzle a little bit more. So with all that delicious seasoning that you said, just to synthesize it, is you're saying I prefer that me and my investors get paid off a percentage of revenue. So kind of further up the P&L or the income statement. And then you also have those transfer rights that are available to say, well, if I want to invest, I can sell that rights to participate in that revenue stream, whatever percentage that is. And you can exit that way. So that's how you get your investors who get paid to wait. So now, that being said, I'm just curious now, with all of your wisdom and your knowledge and your years of experience and making all these investments and doing these wonderful things, we live in quite an interesting world right now. So you and I were talking a little bit about this. So I'd love to get your opinion on a couple of things, starting with, with manufacturing. And you mentioned things overseas, and there's a lot of stuff going on, globalism or non-globalism. I mean, who knows, right? Everybody's got an opinion these days.
Don't get me started.
Yeah. We'll get you started a little bit. So that being said, you mentioned to me before, but do you believe, in your opinion, do you believe that America is losing ground in the innovation race to China? And, what's your perspective on that?
They are. And it's kind of a big question. Whenever you're kind of doing something game changing, it's usually because there's a major problem you're trying to solve in the world. And so the story I gave before obviously is multi-pronged, and, it has richness to it. And it's compelling, and it's in its simplicity and how it works. Revenue sharing, there's much more to it, but the problem it's solving is equally complex and equally challenging, and something that if we want to move the world forward, we need to solve that problem. And that is that America, that is the light on the world, it was created to free the people from tyranny around the world. It was a light that has shined on the world for a couple of centuries now. Like all empires, when you become prosperous, you start to think more and more about, how do I protect what I have today? How do I hold it in my pocket and not lose it? And so that courage that inspired you to come to this country as an immigrant 200-300 years ago starts to lose its charm. And it's more about, how do I protect what I've created now? Once you get in that game and that kind of mindset, you lose the immigrant mindset, that long-term, I'm going to change the world, or I'm going to change this life for my children, to a mindset that focuses on me and how am I going to maximize what I have today. We start to break down as a culture, and one of the kind of the key effects of that change in our culture and our mindset is that we stopped innovating. We stopped innovating in a way that was breakthrough, and we became very, very focused on the next rev of whatever it is we're selling, because I know I can sell it to you, put a few more bells and whistles on it. I can put a premium on that. And then if I'm a CEO of a company measured by short-term performance, right, not long-term growth, I keep my job, the stock price keeps going up, and at least I know I can count on those revenues because I'm only selling the next rev of what I already know people are willing to buy, like the iPhone. When you have to make long-term investments, it doesn't mean it's to the exclusion of being mindful of your share price and your earnings today, but it means that when those earnings come in, you invest a good chunk of them in the future. We've stopped doing that. We spent a decade or more in the United States focused on share buyback programs, where we would use our earnings to buy back our shares, which means earnings over fewer shares, higher earnings per share, higher stock price. So our big companies have really stopped innovating in the breakthrough sense for more than a couple of decades. They've moved their manufacturing offshore, a second phenomenon. And by doing that, we've actually created A-teams around the world that didn't exist before, that are competing for talent. So we have to be worried because it's happening. Our good people are being drawn overseas, where they can be paid more, they can get the capital, build that business. So the A-teams around the world are now competing for talent. So not only are we not innovating, but the people who are innovating in these young companies aren't getting the capital they need. And so we're at, high risk that more and more of our new kind of forest that's growing, that can create the next industrial phenomenon, the fourth industrial revolution, like they call it in the press today, are more and more going to move overseas, where they can find partners that have the manufacturing capability to help them, that have the capital, that want them or inspire them to come on overseas. And so if you're an entrepreneur, it's very, very attractive when you're building something physical, a hardware company, and you're struggling to get venture capital to move from software companies back over to hardware companies. And when they show up at the door, because you need so much capital to actually build that business, they're taking away most of the ownership. So it's a big cry, right? Not only a cry for the entrepreneur, but a cry for the country. So I created Cote Capital and was inspired to do it from 25 years of listening to these entrepreneurs, with the inspiration that I just personally had experienced great abundance from investing in hardware companies with breakthrough innovations, breakthrough IP. I saw the power of it. And if I could move venture capital back over, great. But I also realized it takes a long time to move a guy or a gal who lives in a box, who's paid to live in that box, that mandate on what I invest in, because my track record is betting on it, is based on it. And so I created IP Capital to inspire that movement over, but to also bring the people in to get that movement going, because it's going to take time for the guys who live in the box to move over to my side. So that's kind of a storyline around, again, why I was inspired to create Cote. It's really to solve this problem that we aren't innovating in our big companies like we once did. And in our little companies where it's happening, where it's really going to matter on the physical side of the house, the hardware company, the capital just isn't there. And I want to stop the exodus from happening because that's our only real hope today. It's going to be really hard to stop those CEOs from being focused on short-term returns. Their paycheck depends upon it. Their business depends upon it. So anyway, any questions on that?
Yeah, no, that's phenomenal. So as you're speaking, it just reminds me of a saying that there's a difference between playing to win and playing not to lose. And so it sounds like, in your opinion, that America's gone from playing to win to just playing not to lose. When you mentioned, hey, how do we hold on to what we've got? You're just playing not to lose. How do we operate so we don't lose what we've got? Okay, well, that's one way to do it, but don't expect the high upside if you're just playing not to lose. And so that's such a phenomenal and interesting experience of how the current couple of centuries, and especially lately, how a lot of that overseas, a lot of things moving overseas, and as a result, we've created A teams overseas, and then with the cheap labor and new companies that are popping up as a benefit of a few decades of doing that, now there are some potential rivals who are playing to win on the other side of the pond, so to speak.
And we have to look at it that way because I know we vilify, it's common practice when you grow up. I was a lacrosse player. I'm sure you were a sports player. You learn that there's a competitive environment and you have to be sober about the fact that competition needs to put food on the table over on the other side of the pond. So when you build this business, you need to kind of think about how you're going to protect what you have. And that's another element of kind of how do I start to fund these companies, make sure these hardware companies stay here, are rooted here, and then how do I not limit them and limit their potential by keeping them here, but actually get them to share and scale that innovation around the world, like the guys who developed the wireless technology we talked about earlier that I invested in, or the PCR technology I also invested in. How do you get them to share? And so in a world that's very fear-ridden, we see it in our publications every day, right? It creates fear in us to have the courage, because we hear about our IP being stolen. But I can tell you from my own experience, you've heard the dollars, you've heard the returns, the IRRs. That's all from scaling globally. So if you can think smart about how to protect what you have, you can venture out in the world. There's 8 billion people in the world that you can create value for. And the paradox of all of this is that you actually protect what you have in this world today by sharing it in a controlled way. It's the best way to protect it. And you increase the potential that you will maximize your opportunity, because the more value you create for people in the world, you're actually creating more value for yourself. It's often not thought of that way. We think we have to hold that shiny diamond in our pocket and keep it close to the vest and build those corporate stores, but the heck with sharing it around the world with other teams that could build their own cars with my engine. And I'm going to say that's actually a fool's move. And I always like to give this example that Warren Buffett is an IP investor, just to drive this home for folks. So Warren Buffett goes into Coca-Cola, and Coca-Cola is not a high-tech company, but they are an IP company. That recipe is secret. And they've been able to take that secret, despite what we hear around the world about our IP being stolen. Just to give you an example, if you do it right, you can protect it and you can maximize the value. So Warren Buffett comes into Coca-Cola and he decides we're going to take that recipe around the world and we're going to adapt it and create secrets, mini secrets, I'll call them, in every country around the world, because the food you eat in your country will affect the taste of that recipe. So you need to locally adapt it. So he actually expanded Coca-Cola internationally, really an IP company, an IP property. The property was the recipe, and he created many Me Too's that were adapted. And that's one of the ways in which he was able to create great returns from Coca-Cola. Take a simple product that has a lot of value that people are willing to pay for and scale it. The opposite of what we learned from the press, which is we better hold that diamond in our pocket. We better keep that engine close to the vest. We better build our own cars with our own team and not share it. And I would say, again, that's a fool's move. And I have a line in life I live by. It doesn't mean the rules don't apply, but I always say that the rules often can be for fools because they create boxes around things that are new and different that unless you break the rules, you're actually holding yourself back. And breaking the rules doesn't mean you do that to break the law. It just means you don't live chained in. You break free of the chains, because if you don't do it, the world can't benefit from what you've created anywhere near the way they could benefit if you share it and you scale it. And so I wanted to get that out on the table as well for the audience so they could appreciate that really IP investing, unlike venture capital investing, is all about betting on the team to build its own cars, its own stores, but scaling it so many other teams can create value for your business.
Yeah, absolutely. Phenomenal. So essentially investing in these IP or these defensible assets and then your compensation is tied to revenue. I absolutely love that. So kind of rounded out some of those. So as we round third base, I'm just looking back, you have this vast experience, you've got investment thesis, you got Cote capital, billions of dollars. I want to know, this is the part I said I would ask pretty please for on, is what are some of those in your secret sauce, your view on the world, your investment thesis, all of these things. Maybe you can round out a couple of things for us where that you find helpful and maybe can pass it along to some of our fans around the world. So what are maybe one or two things that you would find quite helpful for people looking to do what you're doing?
So I think, a lot of what I'm explaining, is multi-layered. So I'll hit the high points and then maybe we'll drill down and explain kind of why those things are important to think about. So I like to say the new gold is green, or green is the new gold. And I say that because most of the hardware companies, these companies making new physical products, are actually being driven by demand around the world to turn every company into something that's more sustainable, that's more circular, reuses its waste, pollutes the environment less. There's an enormous sucking sound, pulling sound for any company that can help any industry transform how they produce their products. So a lot of the breakthrough innovation is around helping the rest of the mature company world meet their sustainable development goals. And that actually, believe it or not, creates a high growth, high profit business. We can drill down into some examples if you'd like to really kind of have people appreciate that. The first point is move from software over to hardware. With that context, hardware is where your unicorns will be coming from. That's where the demand is today. Digitizing the world with software post the internet boom was hot. It was hot for 25 years. We've done a lot of that. It's run its course. It's very incremental today. Lots of competition, hard to make money, even though it may sound sexy up front. If you look at the returns, just do a little Googling, you're going to find that software is very, very difficult to make money in today. VCs are struggling. Move over to hardware as point number one. That's where the demand is. And you always want to be where the growth is, where the demand is. And just Google, search, do your own homework on sustainable development goals. And you will find that most of the world, developed and developing, is being pushed to go sustainable, and they need these breakthrough innovations. So you always want to be on a rising tide, and hardware is where the rising tide sits today and will continue for the next several decades.
Yeah, 100% agree. I think the tangible stuff is the next rise of the Titans.
And that's point number one. The second is don't hold a lottery ticket. When you invest in a company, look for companies that are willing to share in revenues, not in equity. Let the company own its business. It's one of the biggest complaints I hear from entrepreneurs, that they're left in the end through many rounds they never anticipated would actually happen because they lived hand to mouth, paycheck to paycheck, and every 12 months, they're out raising the next round. Next thing they know, all the equity's gone, or most of it. And so leave them with ownership of their business. They're going to work harder for you, or they're going to drive that business forward because they can see a pot of gold at the end of the rainbow that history over in venture capital land has taught them. If you talk to entrepreneurs, that more often than not, there isn't that pot of gold at the end. Much of the equity is taken away. So the second thing is, when you move over to hardware, really focus on companies willing to share in revenues, not in equity. Get paid to wait. There's no reason you cannot. It's just living in the box, and the history of owning equity for 10 years, hoping for that lottery ticket to pay out, and reinvesting profits. It's just habit of this is how the model works that has caused people to operate that way. But with these hardware companies, they really can't afford the dilution. You want them to own that business. So the second tip is look for companies, and there'll be more and more of these companies. I'll be driving it. It will be driven in the press. It will be driven more and more. In fact, Intel is building 8 new fabrication facilities in the United States, just to give a really good example, in Columbus, Ohio. And they are financing that with an investor in a revenue sharing model, not an equity model, just to put one big kind of name out there. And so the movement is from software back to hardware, and from holding a lottery ticket in equity over to revenue sharing. And you want to look for those 2 key indicators in an investment, because that's where the future lies, for sure.
I love that. And so what would be a fair percentage of revenue that you like to see when let's go even deeper, man. So maybe you can teach us on this section is, what have you found to be fair on both sides that are, worth your time, but also worth the companies you're investing in? How do you calculate what that is?
So the way I like to do it is, remember, I'm trying to change the risk profile. So I'm not really trying to make a grab, right? It would be bad for my reputation. It would be bad for what my intentions are, which are noble here, to really bring the world forward from software back over to hardware. So what you're really trying to do is get your money back over a reasonable period of time. And what experience shows you is you need these companies. You got to give these companies a good 5 years to really ramp up. And so you design a share of revenues based on that 5-year revenue forecast. Typically, though, you don't rely on the forecast to give the venture capitalist because he's trying to get a higher valuation on the business. It's a real problem. It's more of a pie in the sky kind of number. So you really have to look at that revenue forecast. And usually, in my case, it's heavily discounted around what's real. Who are your customers? What's your pipeline look like? Because I care about the durability of those revenues. I'm not thinking, what's the equity going to be worth in 10 years? I'm thinking, how do I, over 5 years, get my money back for me and my investors? So 100% of your principal, I call it a 1x back over 5 years. You look at that forecast and you put a revenue royalty or a percentage on it, and just run it through the 5 years of that revenue forecast. And when you get to a percentage that gets you 100% of your money back, that's your number.
Wow. So that's perfect. So just seek to recover capital after that. Now, what may be interesting, keep me honest here, is what happens after you get your principal back. I'm assuming that percentage, let's say it's 20%. I'm assuming that 20% is pure profit from year 6 until as long as you hold it. Is that right?
It is. And that's one way to look at it. The way we look at it is we like to hit doubles and triples. So that's the first single is that 5-year kind of return on your principal. That second single or double is really something that is if the company exits, we get a 1x off the top. So my investors, we're looking to get a double over 5 years. It's kind of the way we think. And I'm going to trade that double for the kind of equity ownership a VC would want that might be modeling a 10x or more, because I want my people to know that instead of swinging for the fences and usually striking out in venture capital, when you move over to Cote Capital and IP investing, or IP capital investing as we call it, same kind of thing. We're betting on companies, just our focus is hardware, and we're going to share in those revenues. You want to make sure that you're getting your money back along the way. You're getting another turn or double in the exit when it happens. If the exit doesn't happen, we actually step down our royalty or our share of revenue, so that we're always kind of getting that 1x return every 5 years waiting for the company to exit. And when they exit, we actually design our model to get us a minimum of another 1x. So whenever that exit happens, we get a triple. If the exit doesn't happen, we're modeling a triple through both the 1x along the first 5 years and the continuing royalty thereafter. So again, it's all focused around doubles and triples. Doubles and triples.
I love that. So my impression of this would be your hit rate tends to be a lot higher. So in venture capital, if you get, you do 10 deals, you get 2, maybe 3 of those deals to be home runs, but the lottery ticket, as you like to call it. But then with yours, with this revenue share model, and then you get a little bit of a kickback on an exit, we're assuming that your hit rate, as far as the investors can perceive, is a lot higher. This is just my perception. Yeah. So.
Correct. And the other thing we didn't talk about, there are a few different things to drill down on.
Yeah.
The way we do it is we actually hold the IP assets, which is basically the new designs for that car, that engine in the car, and the car that you've built that's new and different. Mm-hmm. We value that to make sure that our capital is protected. So we hold that asset as security, kind of like real property investing. Again, we design a share of revenues over 5 years to get our money back. We do anticipate a hypothetical exit in year 5. Again, it takes about 5 years for these guys to really get humming in the kind of the breakthrough world of physical products. And we, again, get a 1x out of that exit, and then we model another turn, a third turn, in the way that we get a percentage of the exit. We can hold that percentage of the exit as a straight kind of percentage out of whatever the value of the business looks like at the end of year 5 on that forecast. Or we can hold it, instead of in a contractual percentage, we can hold it in equity. So one way or another, you're over 5 years, you're looking to get a double, 1x along the way, 1x off the top of the exit, and then out of the balance of the exit, get another 1x. And I'll trade that all day long for holding enough equity to get me a 10x. Because, as you said, this is kind of a ground game. I'd rather get doubles and triples all day long because my model's designed both in the way that it's structured to return cash flows to you and the way we hold the assets as security to ensure that the failure rate is 0 or near 0. So low loss rates, unlike venture capital, which obviously, as anybody who reads the press will learn, the rates are no longer, 5 out of 10 losses. It's more like 10 plus losses. You're very, very far and few between in getting those home runs. Mostly it's strikeouts. Yeah. Most venture capital funds fail to return their capital. Very few funds get you that double. 85, there's a famous report from the Kauffman Foundation on their 100 funds, venture funds, and they'll tell you 50% didn't return their capital. 85% only got them less than a double over 10 years. I'm modeling 5. And then only 15% of those funds actually did what they wanted, actually got them a double or more. So when you change the way you think about that investment and move from equity over to revenue sharing, you can really start to change the risk profile. And if you want to bring the people into what I'm doing that don't live in the box, right, aren't bound by a venture capital model, aren't bound by a private equity model, you really have to change the risk profile. Those people aren't in this game for holding a lottery ticket anymore. People have, they've seen that story and they've become discouraged with it.
Wow. So this is good stuff. I hope for you fans around the world listening to this, like, he's literally describing how the new fund model for venture capital is designed. And you know what? You can roll that out in different areas, different asset classes as well. Why not give it a try? I mean, talk to your attorney, make sure that works out for you. But one of the things I'm curious about, Robert, one of the things I want to know is you talked about, you see that the next frontier is, I guess the old frontier is now going to be the new frontier, which is hardware is probably the better place to go than software, which I personally agree. But that being said, I'm curious, with that, let's take that a little bit deeper. So when you find a hardware or, manufacturing company or something that produces something tangible, what are some of those key investment criteria that you like to see when making an investment in a more hardware-based, tangible-based type of company?
So I think the factors are pretty simple, but very important. And so when you move from software over to hardware and incremental innovation over to breakthrough innovation, you start with that as a baseline, and then you need to look under the hood and pay attention to, what is it about that innovation, and is it truly breakthrough? And you want to look at whether or not that breakthrough innovation has high barriers to entry. You don't want to be like a VC or a venture capitalist in a software company worried that somebody will pop up. McDonald's will have a Burger King and a Wendy's, to use a kind of a silly example, very quickly. Yes. You want to make sure, like with a new drug, that you've got 5 or 10 years of kind of monopoly power in that business, a moat around that business, as a Warren Buffett would say. I want to have my business have a moat, and I want to look for different ways in which it has a moat around its business. The first is long development time. So what you'll find in these hardware companies that have done something truly breakthrough, and if this is not true, they haven't done something truly breakthrough. And what I'm about to say is that somebody who's done something truly breakthrough, you'll find those companies have been in business for 5 or 10 years, actually raising capital from angel investors, typically boutique VCs, not the storied VCs we read about, and strategics, companies that may be in the business. So they're kind of bootstrapping their way to market. And those companies typically will see 5 or 10 years of deep science and engineering that's required not only to come up with the breakthrough innovation, but then to implement it, because typically you got to build machinery to make the widget, to make the product, right? And in there, you've got to innovate as well. So you'll find a breakthrough idea and then a rich portfolio of IP, meaning, additional innovation. So breakthrough innovations create cascades of innovation that take many years to develop. So that tells you you have high barriers to entry, long development time. So you want that high barrier to entry. That's one factor. Second thing is you want to invest in a company that is actually sophisticated at protecting what they have. You don't want to be a victim of what you read about in the press, that China will steal my IP or India will steal my IP, because they have A teams over there. And, if you, reveal it fully, you are at risk. There's no question about it. But you want to think about, how do I keep secret the things that I can keep secret? How do I patent the things that no matter what I do, I won't be able to keep it secret? So I need to have another way to legally protect what I have. And when you do that, you're not thinking about, how do I stop somebody? You're thinking about, how do I slow somebody down? Because it's often challenging to stop somebody completely from doing what you're doing. So one is long development times, to give you a high barrier. Second high barrier is sophisticated thinking around how I protect. And the third one, which I think I alluded to at the outset, which is kind of a paradox for most people, is the opposite of what you would think. If you really want to protect it, you share it. And the reason you share it is that most of these guys around the world don't want to spend the money or the time. But if you don't share it, not only are you limiting your market opportunity dramatically, right, and increasing the risk for yourself and your investors that you may fail, but you're actually incentivizing the A teams on the other side of the pond to actually spend the money and the time to come up with some other solution, might be even better than yours. So put aside whether they're going to steal it. They may come up with something that steps in front of you, and they have the skills today. We spent 25 years offshoring our manufacturing and our IP, and we put everybody in school and we trained them how to play our game. So we've got 8 teams around the world. So again, long development times, sophisticated thinking around how to protect, that doesn't look to stop, but is sober about the fact that I've got to do things that will slow people down long enough so I can go share it and get them hooked on what it is that I do, because that's the sure thing to stop them from either stealing and or trying to come up with something that actually may be better than what you're doing. And so those are kind of three principles around high barriers to entry. The second most critical thing that I look at that I think is worth drilling down on as well, durable revenue. So when you move from software and a lottery ticket of holding equity over to hardware and sharing in revenues, well, people say to me, well, how do you know the revenues are going to show up? And I say, well, good question, right? You got to have revenue, otherwise the whole model falls apart, right? So when you go into these companies, I'm not investing, and you shouldn't be investing before they've kind of reached market. And you need to look at the customers who are actually willing to buy today, whether it's MOUs that are binding, whether it's sales contracts, and it will vary from company to company what kind of risk you're willing to take. But you're really underwriting the contract base, both what exists and the pipeline, because you want to be sure of two things. One, that everything you've been told that you think is true is really true, because the only test of that is somebody's willing to pay for that value you say you're creating. And once you can see that, and you can talk to customers and get a good feel for the pipeline's ability to convert, what you'll learn is that most of those guys want to convert. The value is there. And if you can put enough capital behind these companies, unlike in venture capital where you live kind of paycheck to paycheck, round to round, you can gate that capital in, because these contracts will start to fall into place. So I'm underwriting the value by looking at the contracts. I'm underwriting the pipeline. And then I'm thinking about how do I right-size the capital and gate it in smartly as the contracts start to get signed, because they won't be signed if the customer doesn't know that you have the financial wherewithal to deliver. It's a big kind of catch-22 problem for these companies. So just to sum up, high barriers to entry, I give you three different ways to think about that. And then durable revenues, because the model doesn't make sense otherwise. And to think about how do you underwrite that durability? And it really starts with common sense, the contracts. So those are the things I think are pretty important for people to appreciate who want to move from software and equity investment back over to hardware investing, and think about that as IP investing or venture revenue sharing, and not traditional venture capital.
Yeah, nice. I love that. So high barriers to entry, long lead times, and then durability of the business and revenues. That's brilliantly said. So, in this final section of the interview, I typically call it scale it, nail it. So you've told us how you've scaled it. Now I'm curious on the final note and parting words, who in your opinion is nailing it in the areas that's just so impressive to you, and please, whoever that might be, just let us know if you or anyone immediately have any interest in it, so we're compliant.
So there's a lot of great choices. Before I name a company, I'll give a little bit of context for this company, which is the gold standard in IP investing, and I think people will know the name and appreciate the story, and it will really resonate. I want to step back and have folks realize that it used to be that you had to go build everything yourself, right? It used to be that you had to invest in building the stores yourself, as I've talked about at great length. But what you found is a lot of the infrastructure, the manufacturing, the services that you need to build a business today exist in somebody else's hands. And you should leverage that, right? And so what we see in the world today is a lot of companies that are IP companies. They don't actually make something. Or if they make it and then they share it with the rest of the world. They're truly IP companies, truly IP investors in how they grow their business. And that's where the world is headed. So when I move from software over to hardware, many of those hardware companies are IP companies that recognize that they can't be everything to everyone, and they'd be a fool not to leverage the infrastructure, the equipment, the manufacturing, the teams that exist around the world that can help them supercharge the growth of that business. So with that said, the gold standard in an IP company goes back about 30 years. We all know it. It's called Qualcomm. And Qualcomm is a very inspirational story. Here's a couple of guys, Viterbi and Jacobs, and they've got what's called CDMA. It's the most reliable most reliable voice technology out there. We know it. Anybody who owns a Verizon phone versus an AT&T will experience that benefit. But they basically were unable to build a business in the U.S. They had to go overseas. To go back to my point earlier, we have to be very, very careful that we fund our companies in this new way, look at them as IP properties and fund them in a revenue sharing way. Otherwise, they're going to leave. So Qualcomm had to go to Korea to actually build a business. The Koreans were willing to build their business for them. The good news is they came back home. Okay, once they demonstrated to the world that CDMA was much more reliable than what AT&T had, which was called GSM, much more reliable voice technology, not dropping calls, et cetera. So Qualcomm basically had to make a choice of how they build their business. Do I build my own phones with my own wireless chip in it that does CDMA, my own engine in the car? And do I go out and try to compete with all the companies around the world that build phones? Do I rebuild all that infrastructure and sell my own phones? Too much manpower, too many years to build that business, and too expensive. And certainly investors would, especially back then, it was still that old venture model. We live round to round, we build a store at a time, slow and steady wins the race. And so it's a long road, and it would take years, decades before you'd enter the rest of the world. So they made a choice to get out of the phone business. There used to be Qualcomm phones, and just sell the engine in the car and become the best team in the world at selling that engine and stay out ahead of everybody else by investing more money and investing in better people to always have a better CDMA chip than anyone else in the world. So that's point number one. They were an IP company now. They decided to become an IP company, not a traditional venture-backed company. And they made this choice because they realized that the rest of the world could create much more value for that business than they could ever do themselves. And so to finish the story, the way the chip market worked at the time, when you sold a chip, you got $10 for that chip, and it went in a $100 phone, a cell phone. And they realized that that chip would get a $10 sale price, and the phone maker would only want to give them 50% profit margin because that's how the box works. That's how we build that kind of business when you're a chip guy. And so they realized that they needed to sell the chips and make the margin and license anybody in the world, okay, who wanted to buy their chip to also use it in a phone. So they collected a 5% share of revenues on every phone. So here you are, McDonald's-like business. McDonald's is an IP company, actually. Starbucks is an IP company. More simple in the IP. It's more about process and branding IP. But now here we go, big tech, high tech, Qualcomm, the engine in the car, and they're sharing that car around the world. Well, today, Qualcomm makes north of $25 billion a year in annual sales. 2/3 of that is from selling chips. Let's call it 15 billion for simple math. 10 billion of that is from allowing other people to sell phones with their engine in the car that they could never achieve on their own. So they supercharge the growth of their business, and they're the gold standard in everything I'm talking about today. How do I look at this new growth of hardware companies as IP companies? How do I realize that I can do a lot more? How do I get them sobered up to realize that they can do a lot more for themselves in looking at what they've got as a chip or an engine in a car? And how do they get comfortable sharing it? So that's the gold standard. And that's why I'm really, really super excited about the market. To me, it's a no-brainer to move from software back to hardware. Of course, I experienced extraordinary returns from doing it myself for 20 years, and now I've opened Cote Capital up to professionally do it and bring the accredited investor world and the humanitarian funds around the world in to participate with me because they don't live in boxes and they can see that this is where the future lies. And if we don't fund it, we're holding back our country I'm an American. We're holding back the light that shines on the world from continuing to be prosperous, and we're holding back the rest of the world. And I always like to tell people our empire was built unlike any other empire in the world. Every empire in the world was built on stealing the land and resources of others. This empire was inspired by bringing the people from around the world to this country with an immigrant mindset to think centuries, generations, long term, not short term, and inspired to share their innovations around the world, to create value for the world and share in that value. And so America is the quintessential example. Actually, the more I think about it, if you ask me about a company, I gave you Qualcomm. If you ask me about a country, I say America, actually. It's how it built its empire. Hopefully that's interesting to your audience and you find it compelling.
Yeah, I love that. And do you have any holdings of Qualcomm yourself?
I do not.
Okay. Perfect. So if you're going to bet on some companies that are able to scale and all those things. So as we wrap things up, any last minute things you want people to know? Any way you want people to reach out to you? Any final comments?
I think I'd like to give a couple of examples so people really appreciate what I'm talking about a hardware company that has an engine in a car, has something unique that they can share around the world.
You bet. Closing remarks.
And how the sustainable development goals in the world are driving those companies' success. And so probably a really good example is one of my companies is helping transition the textile industry. You'd say textiles, that sounds boring and very low profit. And you'd be right? America's moved its textile industry overseas. So what I'm investing in will bring manufacturing back to America and rebuild the textile industry, but it will also create value around the world. And here's why. This company has come up with a way to meet the goals of the H&Ms of the world, all the major brands who are under pressure from the public and governments to change the way they manufacture. I don't know if people know this, but it takes 10,000 liters of water to make one pair of jeans. You can go Google it. I know it sounds absurd, sounds hard to believe, but it's true. Most of that white water goes in our water streams and pollutes our water, and the carbon emissions from producing that pair of jeans are enormous. It's the second largest polluter of the atmosphere behind the oil and gas industry. So here comes an industry, and here comes a really cool breakthrough innovation. So this woman who developed this technology into a line of equipment can take the waste, whether it's off your back when it goes in a recycling bin, or whether it's off the factory floor after they cut and sew the garment. There's a lot of waste, billions of kilograms of cut and sew waste. She can actually take that waste, put it through her line of equipment, proprietary equipment, breakthrough in and of itself in its hardware, and then into the process recipes, kind of a Coca-Cola kind of notion, right? She can take different types of fibers from all kinds of clothing and turn that waste fiber, that clipping, into a brand new fiber, a virgin quality fiber out the other end. And she can take all that waste, turn it back into something you could turn into a yarn, into a fabric, and now H&M or Zara, anybody in this kind of fast fashion world can now make the same garment, and they all have goals to go 30% recycled in all their clothing by 2025, 100% recycled material in their clothing by 2030. And you can look up and you can look for those goals. And so I would say to the audience, go look at the industries, look what sustainable goals are being put out there by these companies, and look at the young companies that are trying to drive the industry towards those goals. Those are the companies that you want to be investing in because they're changing the game. And to put a cherry on top of this for the audience, that waste you can buy for pennies on the dollar, but you can sell it for the same $3 to $4 that virgin fiber would cost. So what a business, right? High margin, high growth. You can see it in the numbers I just put out there. And that's the value of sustainable development related technologies that take waste, turn it into brand new, or reduce kind of the impact that a company has on the environment, which usually is efficiency. Usually sustainable development goals result in a company being able to use fewer things, right, at lower cost to make the same garment so their profits go up. So I wanted to kind of get that on the table. I know it's a kind of a long-winded discussion, but I want the audience to really appreciate this. Green is the new gold. This is not made up. You can go and look in any industry, and everything that I've said you will find to be the case. And to leave them with a third tip, if we want to have a third tip, that's the sure way to find the companies that you want to bet on, the young companies you want to bet on, the ones driving those goals forward in those industries for the big companies.
I love that. So, just to, as we wrap things up, to synthesize everything, seek to get returns from revenues more than equity. The other thing that Robert told us is you really want to look for companies with high barriers to entry. And then finally, you want to look for companies that prioritizes product excellence and R&D, like your Qualcomm example. You do these things, and you too can be well on your way in your pursuit of making billions.